If you've been following the 60-40 rule, 60% stocks, 40% bonds, you weren't doing anything wrong. That strategy was the right call for a long time. Smart people built real retirement security with it. But here's what actually matters right now. The conditions that made 60-40 work so well have shifted. And if you're in your 50s or early 60s, this is worth understanding, not because you need to panic, but because a few thoughtful adjustments could make a real difference in how your retirement holds up. Let me break it down.
The 60-40 portfolio has roots going back to the 1950s. The idea was straightforward. Put 60% in stocks for long-term growth and hold 40% in bonds as a cushion. When markets dropped, you'd sell your bonds, which typically held their value, instead of being forced to sell beaten-up stocks at the worst possible moment. That second part is the key. It's what financial planners call sequence of returns risk. Think of it this way. If a major market drop hits in your first year of retirement and you have no safe assets to draw from, you're forced to sell at a loss. You lock in the damage before the recovery ever comes around. Bonds were specifically designed to prevent that scenario. And for about 4 decades, they did exactly that. From the early 1980s through the 2010s, interest rates were in a long, steady decline. When rates fall, bond prices rise. So bonds weren't just stable, they were quietly appreciating. The 60-40 portfolio was almost perfectly suited to that era. Here's the honest reality. That era is over.